Have you ever thought about how the government pays for all the things it does, like building roads and schools? Well, one of the main ways is through income tax. Simply put, income tax is a part of your income that you give to the government. This money is then used to support important things like healthcare, education, building new roads and bridges, and helping those in need. It's like putting money together as a country to make life better for everyone. Every rupee of income tax counts and helps build a stronger and better India for all of us. When we pay our taxes, we're doing our part to make India a better place. Now, you might be wondering, do I need to pay income tax? The answer is simple. If you earn money in India that is considered taxable income, then yes. This applies to everyone, whether you're a regular employee, a business owner, or even a freelancer. If you earn more than a certain amount set by the government, you need to pay income tax. The government has different categories for taxpayers to make sure the system is fair. These categories include individuals, families, companies, and more. Each category has its own rules about income tax. Also, whether you live in India or not affects how much tax you need to pay. We all know that money comes from different places. To make calculating tax easier, India has 5 main categories for income. These are money from a job, money from renting out a house, money made from selling assets like property or stocks, money made from a business, and money from other sources. It's important to understand these categories because the way you calculate tax depends on where your income comes from. For example, the way you calculate tax on your salary is different from how you calculate tax on profits from your business. Remember, not all income is taxable. Some types of income, like money earned from farming, are exempt from tax. In India, you can choose between 2 ways of calculating your taxes: the old regime and the new regime. The old regime has been around for a long time and has a lot of deductions and exemptions which can make it a bit complicated. The new regime is newer and simpler, with lower tax rates but fewer deductions. Choosing the right one depends on your own money situation and how you like to invest. If you want to use deductions to reduce your tax, the old regime might be better. But if you prefer simplicity and lower tax rates, the new regime might be a better fit. It's best to talk to a tax expert to figure out which option is best for you. Section 5. Capital gains and taxation. When you invest in things like property or stocks, you can make a profit. This profit is called capital gains. But did you know that you have to pay tax on these gains too? The amount of tax you pay depends on what you sold and how long you owned it for. If you owned it for a short time, it's called short-term capital gains, and the tax is different from long-term capital gains, which is when you've owned something for a long time. The time period that decides if it's short-term or long-term is different for different types of assets. Understanding how capital gains are taxed is really important when you're deciding what to invest in. Section 6. Navigating financial and assessment years. The financial year and the assessment year are 2 important terms you'll hear a lot when it comes to income tax. The financial year is from April 1st to March 31st, and it's the year when you earn your income. The assessment year is the year after the financial year, and it's when you file your tax return. For example, if the financial year is 2024 to 2025, the assessment year would be 2025 to 2026. Knowing the difference between these 2 years is super important for filing your taxes correctly. Section 7. PAN and TAN Essential Tax Identifiers. When it comes to income tax in India, there are 2 very important identification numbers you need to know about: PAN and TAN. PAN stands for Permanent Account Number, and it's like a unique ID card for your taxes. It's a 10-digit number with both letters and numbers, and the income tax department gives it to you. You need your PAN card for many financial transactions. TAN stands for Tax Deduction and Collection Account Number. You need this number if you're deducting or collecting tax at source, which is also called TDS, TCS. TAN makes sure that these tax deductions are being paid to the government correctly. Section 8. Paying your taxes, methods and options. Paying your taxes is much easier now than it used to be because there are so many ways to do it. You can choose to pay through TDS, where the tax is taken out of your income before you get it. Or you can choose to pay advance tax, where you pay your taxes little by little throughout the year. There's also self-assessment tax, which is where you pay any remaining tax that's due after considering your TDS and advance tax payments. And now with technology, e-payment has become a very popular and easy way to pay your taxes online. Section 9. Filing your income tax return. A step-by-step guide. Filing your income tax return is super important because it's how you officially tell the income tax department how much you earned and how much tax you paid. The process has become much easier over the years, and now you can file your tax return online from anywhere you have internet access. The deadline to file your return is usually July 31st of the assessment year. Remember, filing your tax return on time is very important to avoid penalties and legal problems. Once you submit your return, you'll get a confirmation called ITR VI. This is your proof that you filed your taxes.